Welcome to The Explainer. Today, we're looking at a totally fascinating financial instrument that was literally born out of pure necessity. I want you to imagine the year 1992. A devastating storm, Hurricane Andrew, is about to completely upend the global insurance industry and, well, force the creation of an entirely new market.
$27 billion. Let that sink in for a second. That's the staggering amount of damage Hurricane Andrew caused when it slammed into Florida and the Gulf Coast. For the property and casualty insurance industry, this wasn't just, a bad year. It was a full-blown existential crisis. I mean, the storm bankrupted up to 11 insurance companies and pushed a whole bunch of others right to the absolute brink of insolvency. The traditional model of insurance, it simply couldn't handle this scale of concentrated destruction, which forced insurers to drastically slash their coverage in coastal areas.
Section 1. The birth of catastrophe bonds.
So that massive shortfall in insurance capacity after Hurricane Andrew, it demanded a radical, truly innovative solution. Enter the mid-1990s, when Richard Sandor, Kenneth Fruit, and a group of professors at the Wharton School got together and conceptualized a brand new financial vehicle. Their primary goal was pretty straightforward: bring the vast, untapped capital of broader financial markets directly into the catastrophe reinsurance space. The very first experimental transactions were actually pulled off by major institutional heavyweights like AIG, Hanover Re, and USAA. They essentially built a bridge, pulling in much-needed fresh capital from investors to act as a massive backstop for the insurance sector.
Okay, let's dive into this. Section 2. How catastrophe bonds work.
To really understand how these unique, non-investment-grade securities actually function, we've got to follow the money. It's a four-step process. First up, investors. Think hedge funds or pension funds who are hunting for returns that aren't tied to the regular stock market's ups and downs. They provide cash principal to a middleman. This is called a special purpose vehicle, or SPV, which basically acts like a highly secure financial lockbox. Second, that cash doesn't just sit there gathering dust. It's safely invested, typically in U.S. Treasury money market funds. Third, while they're waiting around, the issuer, which is usually an insurance company, pays annual coupons or interest directly to those investors. And fourth, if the bond reaches its maturity date without a predefined disaster happening, boom, the principal is returned to the investors. But, and this is the big but, if a specific disaster does trigger a payout, that principal goes straight to the insurer to cover their massive wave of claims.
Now you might be wondering, why on earth go through this whole complex process? Well, the main difference lies in security. You see, traditional reinsurance is subject to counterparty failure. That means if the reinsurer goes bankrupt right after a mega disaster, the primary insurer might just never get paid. Talk about a nightmare scenario. But catastrophe bonds, they are 100% collateralized. Because that cash is already sitting right there in a secure account, it completely eliminates counterparty risk for the issuer. Plus, as an added bonus, they offer multi-year price locks, whereas your traditional reinsurance is usually a headache negotiated year by year.
Section 3. Crises and turning points.
The cat bond market certainly didn't just grow in a vacuum. Its financial evolution actually maps directly to real-world chaos. It's a fascinating timeline. We start with that 1992 Hurricane Andrew crisis we talked about. Then, the very first bonds hit the market in 1997. Jump ahead to 2005, and Hurricane Katrina's catastrophic $62 billion in insured losses rapidly depleted traditional reinsurance capital. This drove a massive, record-breaking issuance of cat bonds, as insurers were just scrambling for alternative protection. Then 2008 hit. The whole Lehman Brothers collapse actually brought the entire cat bond market to a screeching halt. Why? Because Lehman was acting as a counterparty in several major deals. But this crisis was actually a turning point. It forced a necessary structural change, pushing the market to adopt those highly secure Treasury-backed collateral structures that are the absolute gold standard today.
Moving on to Section 4. Impact on society. Triggers and real payouts.
Far beyond corporate balance sheets, these bonds are having a profound impact on society at large. If we look at the historical breakdown, primary insurance companies make up about 60% of issuers, and reinsurers sit at 25%. But here is the absolutely crucial part. 15% comes from state funds. Public entities like the California Earthquake Authority and Mexico's Fonden use these bonds heavily. When private insurance pulls back from really high-risk areas, like earthquake zones in California or hurricane-prone coasts in Florida, these state-sponsored entities step right in. They tap into global capital markets to guarantee that they have disaster recovery funds available for the public when the worst happens.
So how exactly is a payout decided when a massive storm actually hits? Well, there are three main trigger mechanisms you need to know. First is indemnity. This is based on the actual verified losses experienced by the issuer. It's highly precise, mostly used by primary insurers, but honestly, it takes a really long time to calculate. Second is industry loss. This looks at aggregate losses across the entire insurance industry, usually estimated by a third party. Reinsurers tend to prefer this one. And finally, we have parametric. This one is based purely on the measured physical strength of the disaster itself. Think a hurricane's specific wind speed or an earthquake's exact magnitude. Governments and state funds love parametric triggers because they completely bypass those lengthy claims adjustments, allowing for incredibly fast emergency payouts when cash is needed immediately.
To truly grasp how these triggers function in practice, we've got to understand one foundational definition, and that's the attachment point. Think of it as the contractually agreed-upon threshold of financial losses or disaster severity that absolutely must be reached to trigger a cat bond payout. It is the definitive line in the sand. If a disaster crosses it, the investors lose their principal, and the issuer receives the funds. Simple as that.
Let's anchor these mechanics in reality using a pretty striking historical case study. Back in 2010, a special-purpose vehicle called Mariah Re issued a bond on behalf of American Family Mutual Insurance. Fast forward to the spring of 2011, and an absolutely unprecedented string of tornadoes devastated the United States. An independent third-party modeler was tracking the damage. Eventually, just a single storm classification change pushed the estimated industry losses to $954.6 million. That was well past the bond's $825 million attachment point. This singular change wiped out the investor's principal completely and provided the insurer with a massive $100 million payout. It is a really stark reminder of the real-world, high-stakes nature of these financial thresholds.
Let's transition to Section 5, Current Status, Climate Change and Society. That brings us to the modern era, where the scale of this market is just staggering. $43.1 billion. That was the estimated size of the catastrophe bond market at the end of 2023. This explosive growth is really being driven by two main factors. On one side of the coin, you have institutional investors seeking out high yields in a fairly volatile global economy. On the flip side, insurers are facing an increasing frequency of what the industry calls secondary perils. We're talking about events like severe floods and devastating wildfires, which, as we all know, are being heavily amplified by climate change. However, as this market balloons, it is facing some really intense scrutiny. A super significant, very recent example of this debate happened in 2024, when Hurricane Beryl caused extensive damage across the Caribbean. Yet Jamaica's catastrophe bond did not pay out a dime. Why? Because the storm, despite all its clear destruction, failed to meet the specific minimum air pressure threshold that was literally written into their parametric contract. Critics are quick to point out that these highly complex parametric triggers can sometimes completely fail to reflect the actual lived devastation on the ground. And that leaves vulnerable nations without the expected capital market protection right when they need it the most. Section 6. The Future Outlook, Beyond Natural Disasters. Now, despite those operational debates, the core mechanism of transferring catastrophic risk over to capital markets is proven to be highly adaptable. It's actually moving into entirely new systemic risks. For example, there are now bonds covering massive cyber attacks, pioneered by companies like Beazley and Axis Capital back in 2023. There's coverage for terrorism risk, which was utilized by the United Kingdom's Pool Re in 2019. The World Bank has even issued pandemic emergency financing bonds and is actively pushing to launch impending African drought bonds, which are expected by mid-2025. The foundational architectural concept here, packaging enormous uncorrelated risks and selling them off to global investors, is rapidly expanding into completely uncharted territories.
Which brings us to Section 7. Conclusion. The financialization of disasters.
Over the past 30 years or so, catastrophe bonds have evolved from a highly experimental response into a massive multi-billion-dollar pillar of global risk management. But I want to leave you with a final provocative thought to chew on. As climate change continues to intensify physical risks all around the globe, are these global capital markets the ultimate buffer against nature's fury? Or are they simply a complex financial gamble? It's a heavy debate, and one we are actively navigating as society desperately searches for ways to fund its own resilience. Thank you so much for joining me for this explainer, and as always, keep questioning the systems that shape our world.